Your LLC does not help you save on taxes. It does nothing for your taxes, actually. There seems to be a lot of misconception on what an LLC is and what it does, especially if you're looking to start a business. There's so many people out there saying this and that you don't know what is correct and what is wrong. Some people think an LLC automatically lowers your taxes as soon as you create it, while others think that an LLC is required to take business deductions. In this video, let's make it crystal clear in plain English on what an LLC is, what it does and doesn't do, and when you would need one. Now, before we move on, my name is Jonathan and I am a licensed enrolled agent and CEO of Reserve Tax Advisors. If you are making at least $300K in net income and are tired of having your hard-earned money bleed to taxes, schedule a consultation with us to see how we can help you keep your money where it belongs while protecting everything that you've built up to this point. Reserve Tax Advisors works exclusively with high-income individuals and business owners with our expertise in strategic tax advisory to help you leverage the tax code to your advantage so you can take control of your taxes. The link will be in the description and we look forward to hearing from you. Now back to the video. An LLC is an acronym for Limited Liability Company, and this is a business structure that you can create with the state that gives you some separation between yourself as an individual and your business. You can look at it as if your business is its own person now. There is a level of separation between you and your business, which is always good. Now, creating an LLC itself doesn't give you any tax benefits, but it does give you a few things. Limited liability. The limited liability part of LLC means that your personal assets, such as your home or your bank accounts, are generally protected from the debts and lawsuits of your business. For example, if someone sues your business, only the assets in your LLC are at risk, not your personal assets. However, it is important to note the limited part of limited liability as well. There are some instances where your personal assets can also be at risk in certain situations, but that's beyond the scope of this video. Separation. Creating an LLC opens up some great opportunities for your business and creates a bit of separation, like I mentioned before, between you and your business. Now, some of these opportunities that an LLC gives you is being able to apply for an EIN, which is basically a social security number for your business. An EIN is important because after you get one, you can use your EIN instead of your social security number on various paperwork, such as with vendors and with clients or customers. Having an EIN also allows you to open a business bank account and business credit cards, which helps in establishing your business credit and credibility with external partners such as with banks and lenders. An LLC also gives you some flexibility. An LLC gives you the flexibility to make various elections and gain protection in exchange for minimal paperwork and administrative work. Now that we have a better understanding of what an LLC is, when do you need one? You should form an LLC when you're starting to make some income through business activities, as well as if you're in the business of working with other people. Working with others, whether it's other businesses or customers, always brings a level of risk or liability in case something goes wrong. An LLC would be your first layer of protection in case something does go wrong, and there's a possibility that someone can sue your business like we talked about before. In other words, if you just started your business today and are in the stage of planning on how to get your business going, you most likely don't need an LLC at this point. But when you have your business plan set and are beginning to look for your clients or customers, that would be a good time to create the LLC. It can generally cost anywhere from $50 to maybe a few $100s depending on the state, but the cost is very minimal compared to the protection that the LLC gives you. Now, when you first start your business, you start off with what is called a sole proprietorship. This doesn't require any paperwork and you are automatically considered a sole proprietorship the second you begin your business. In the case of a sole proprietorship, there is no distinction between you and your business. You are the business and the business is you. What this also means is that if someone sues your business, it means that they're also suing you, and anything you own personally is at risk because you don't have the limited liability protection that an LLC gives you. As you can see, a sole proprietorship is good because there are no fees, There are no paperwork since it is a default classification. But the negative side of a sole proprietorship is that you have no protection whatsoever. Everything you own is at risk, so it is a good idea even before you meet with customers to start off with an LLC. If something goes wrong, everything you own is at risk, and in order to change that, that's where the LLC comes in. And it doesn't cost much, but does give you a good level of protection. So now that you understand what a sole proprietorship is and are looking to create an LLC, how many members can you have? Well, when you create your LLC with the state, you will need to identify who the members of that LLC will be. In most cases, you'll be the only member when you first start out and will be considered what is called a single member LLC. It's important to note that a single member LLC is considered disregarded for tax purposes because it is not a tax entity. It doesn't change anything for tax reporting purposes, which means that any business activity will stay within your personal return on what is called a Schedule C, and you will not need to file or prepare any other business returns. This in turn also means that the people who say that an LLC can help you save on taxes are also wrong. Creating an LLC by itself does nothing to help you save on taxes. Now, in the case where you have a friend or business partner that you create an LLC with, both of you will be listed as members on the paperwork, and now it will be considered a multi-member LLC. A multi-member LLC is automatically classified as what is called a partnership by the IRS, and it's a little different than a single member LLC. Here are a few points to remember for a partnership. Now, number one, a partnership files a separate business tax return called a Form 1065. You'll need to file this in addition to your personal return, and that goes for your business partner as well. You'll also start to receive what's called a Schedule K1, which comes from your partnership return. This K1 serves as a summary for your business activities throughout the year, and it's going to be required to complete your personal returns. So you'll need to plan on making sure that your business return gets completed first before you file your personal return. Number two, a partnership requires a bit more organization on your part since it now requires its own business return. You'll need to keep accurate records of all business-related activities, such as your income and expenses, just like you would if you were a sole proprietorship. But now, you'll also need to keep track of your bank balance, credit card balances, loans, and everything else to have an accurate balance sheet on the business return. The most common way to keep track of these items and to create the financial reports for your tax preparer would be to use a software like QuickBooks for bookkeeping purposes. And number three, a partnership must always have at least two partners. If one partner decides to exit the business, dies, or is not involved with the business for any reason, the partnership will turn back into a sole proprietorship. Now, there is an exception for when a partnership is created between two spouses. If an LLC has two spouses as the members, the married couple can elect to do business as a qualified joint venture. Now, what this means is that even if it is a multi-member LLC with two spouses as the members, the qualified joint venture election allows the couple to do business together, but file as two sole proprietors instead of having to file as a partnership. Now, this does give a few benefits, such as no need for a business return, which simplifies tax filing. Both spouses also get credit for Social Security and Medicare earnings, which will be important for retirement. Working with a business partner can be great since two minds are always better than one, but it does come with some additional paperwork, organization requirements, and a separate tax return that needs to get filed every year. Later on down the road, an LLC can also let you make an election to be treated as an S corporation for tax purposes, but that's something for another video. But you just need to know that an LLC will give you that option to make that election later on. Now, we did just go over a lot of information here, but let's conclude this video and summarize everything we just talked about. An LLC gives you protection, separation between you and your business, flexibility. You should make an LLC when you are generating some income through business activities, or if you are in the business that works with clients or customers where there is a risk of liability. You wouldn't necessarily need an LLC if you just started the business and aren't working with others at the moment, since you won't have any risk of liabilities at that point. But since the cost is very minimal, it's good to just start off with the LLC and get the paperwork out of the way so you can focus solely on your business. A single member LLC means that you're the only member of the LLC and it is considered disregarded for tax purposes, which means there are no different filing requirements, nor does it do anything for your taxes. It's just for the protection that it provides. If there are 2 or more members, the LLC is considered a multi-member LLC, which means it is now a partnership. A partnership requires its own return, it requires a bit more organization, and must have at least a minimum of 2 partners. An exception to the partnership is if a married couple is working together. The couple can make a qualified joint venture election, which will allow each spouse to file as 2 sole proprietors instead of as a partnership. Some benefits of making the qualified joint venture would be that you don't need to file a separate business return, and both spouses get credit for Social Security and Medicare earnings, which is going to be important for retirement. Now that's it for this video, and I hope this masterclass has given you some clarity on what an LLC actually is, what it actually does, and when you would need one. Again, my name is Jonathan with Reserve Tax Advisors. If this video has helped you out, if you learned something from this video, please leave a like, please subscribe to the channel. It'll really help out a lot. And please leave a comment if you have any other questions. I'll be sure to get to every single comment there is to help you understand more about everything that has to do with taxes. Thanks for watching this video, and I will see you guys on the next one.